What if your behavior decided your financial freedom? Not how much you earn, not how much you save, but how you act, comply, and live within a system. Imagine a world where access is no longer universal, where every action leaves a trace, and every trace becomes data. This is not a prediction. This is already the logic behind the social credit system. A social credit system is a data-driven scoring framework. Its purpose is to evaluate trust, compliance, and risk, not just financially, but behaviorally. Each individual or entity is assigned a dynamic score. This score is not static. It updates continuously based on actions, decisions, and patterns. Higher scores unlock access. Lower scores introduce friction. The system does not rely on force. It relies on automation. The system begins with data collection, financial transactions, payment reliability, energy usage, mobility patterns, digital interactions. Algorithms analyze this data in real time. Behavior is categorized, risk is calculated, and trust becomes a measurable variable. The result is a living score, constantly adjusting, constantly learning. In traditional finance, decisions are periodic. In a social credit-based system, decisions are continuous. Loan conditions may change automatically. Interest rates can rise or fall based on compliance. Spending permissions may expand or shrink without human approval. Money no longer functions as a neutral medium. It becomes programmable, conditional, responsive. Finance evolves from choice-based to rule-based. Elements of social credit systems already exist. Credit scores, risk ratings, reputation metrics. What is new is convergence. When financial systems integrate with digital identity, when policy enforcement connects to payment infrastructure, scores stop being isolated tools. They become a unified access layer. Supporters highlight efficiency. Fraud prevention improves. Risk management becomes automated. Systemic trust increases. Institutions can allocate resources faster and more accurately. Compliance becomes frictionless. But critics raise serious concerns. Privacy erodes when behavior is constantly evaluated. Errors become penalties, and appeal mechanisms may disappear. When access depends on scores, freedom becomes conditional. Social credit systems do not operate alone. They integrate with digital ID, with programmable money, with carbon scoring and AI surveillance. The result is an ecosystem where finance reacts instantly to behavior. Access is no longer a right. It becomes a variable. Efficiency increases. Autonomy decreases. This system does not announce itself as control. It presents itself as optimization, convenient, efficient, automatic. The future of finance is no longer just about money. It is about rules embedded in code, about behavior translated into access. The question is not whether these systems will exist. They already do. The real question is, who designs them? Who controls them? And who decides the rules? Efficiency or control? That choice is still unfolding.